The housing market is about to flip. Here's why. Unlike the stock exchange where people understand and accept the danger that prices may fall from time to time, sometimes severely, many folks that buy a house don't really think that the value of their home will ever decrease by all that much. Indeed, historically, the housing market has not been suffering from price bubbles in comparison with other asset classes that could flow from partially to the massive transaction costs related to purchasing a home, to not mention the carrying costs of owning and maintaining a home, all of which discourage speculative behavior. However, housing markets do sometimes undergo periods of irrational exuberance and see prices rise rapidly before falling back in line. Today, we will be talking about how the housing market is about to flip. Stick till the end of this video, cause it's going to be hella informative. Ever heard about the housing bubble? What is a housing bubble? Before stepping into the causes of housing bubbles and what makes them go pop, it's important to know a housing bubble in and of itself. These generally begin with a jump in housing demand, despite a limited amount of inventory available. Demand further increases when speculators enter the market, making the bubble bigger as they snaffle investment properties and fixer-upper flips. With limited supply then much new demand, prices naturally rise. Housing bubbles have an instantaneous impact on the important estate industry, but also homeowners and their personal finances. The impact of bubble can wear the economy can force people to seek out ways to stay up with their mortgage payments when times suddenly turn and obtain tough. Some may even got to dig deeper into their pockets, using savings and retirement funds just to remain their homes. Others will go bankrupt and foreclose. Any bubble is normally just a temporary event. Although bubbles within the equity markets can happen more frequently, housing bubbles can persist for much longer, consistent with the International Fund, IMF, and will last several years. Causes of housing market bubbles. The price of housing, just like the price of any good or service during a free market, is driven by the law of supply and demand. When demand increases or supply decreases, prices go up. In the absence of some natural disaster, which can decrease the immediate supply of homes, prices rise when demand tends to outpace supply trends. The supply of housing can also be slow to react to increases in demand because it takes an extended time to make or fix up a house. And in highly developed areas, there simply is no more land to create on. So, if there's a sudden or prolonged increase in demand, prices are bound to rise. Once it's established that an above-average rise in housing prices is initially driven by a requirement shock, we must ask what the causes of that increase in demand are. There are several possibilities. A rise generally economic activity and increased prosperity that puts more income in consumers' pockets and encourages homeownership. An increase within the population or the demographic segment of the population entering the housing market. A low, general level of interest rates, particularly short-term interest rates, that creates homes cheaper. Innovative or new mortgage products with low initial monthly payments that make homes cheaper to new demographic segments. Easy access to credit, often with lower underwriting standards, that also brings more buyers to the market. High-yielding structured mortgage bonds, MBS, as demanded by Wall Street investors that make more mortgage credit available to borrowers. A potential mispricing of risk by mortgage lenders and mortgage bond investors that expands the supply of credit to borrowers. The short-term relationship between a mortgage broker and a borrower under which borrowers are sometimes encouraged to need excessive risks. A lack of monetary literacy and excessive risk-taking by mortgage borrowers. Speculative and risky behavior by home buyers and property investors fueled by unrealistic and unsustainable home price appreciation estimates. An increase in home flipping. Each of those variables can combine with each other to cause a housing market bubble to require off. Indeed, these factors tend to feed off of every other. An in-depth discussion of every is out of the scope of this text. We simply means generally, like all bubbles, an uptick in activity and costs precedes excessive risk-taking and speculative behavior by all market participants, buyers, borrowers, lenders, builders, and investors. Forces that burst the bubble. The bubble finally bursts when excessive risk-taking becomes pervasive throughout the housing system and costs not reflect anything on the brink of fundamentals. This may happen while the supply of housing remains increasing in response to the prior demand spike. In other words, demand decreases while supply still increases, resulting in a sharp fall in prices as nobody is left to shop for even more homes and even higher prices. This realization of risk throughout the system is triggered by losses suffered by homeowners, mortgage lenders, mortgage investors, and property investors. Those realizations could be precipitated by sort of things: an increase in interest rates that puts homeownership out of reach for a couple of buyers and, in some instances, makes the house a private currently owns unaffordable. This often leads to default and foreclosure, which eventually adds to this supply available within the market. A downturn, generally economic activity that leads to less income, job loss, or fewer available jobs, which decreases the demand for housing. A recession is especially dangerous. Demand is exhausted, bringing supply and demand into equilibrium and slowing the rapid pace of home price appreciation that some homeowners, particularly speculators, calculate to make their purchases affordable or profitable. When rapid price appreciation stagnates, people who calculated to afford their homes may lose their homes, bringing more supply to the market. The bottom line is that when losses mount, credit standards are tightened, easy mortgage borrowing is not any longer available, demand decreases, supply increases, speculators leave the market, and costs fall. The 2007 to 2008 housing market crash. In the mid-2000s, the U.S. economy experienced a widespread housing bubble that had an instantaneous impact on bringing on the Great Recession. Following the dot-com bubble, values in land began to creep up, fueling a rise in homeownership among speculative buyers, investors, and other consumers. Low interest rates, relaxed lending standards, including extremely low deposit requirements, allowed people that would otherwise never are ready to purchase a home to become homeowners. This drove home prices up even more, but many speculative investors stopped buying because the danger was getting too high, leading other buyers to urge out of the market. Indeed, it closed that when the economy took a turn for the more severe, a whole lot of subprime borrowers found themselves unable to pay their monthly mortgages. This in turn caused prices to drop. Mortgage-backed securities were sold off in massive quantities, while mortgage defaults and foreclosures rose to unprecedented levels. Mean reversion. Too often, homeowners make the damaging error of assuming recent price performance will continue into the longer term without first considering the long-term rates of price appreciation, and therefore the potential for mean reversion. The laws of physics state that when any object, which features a density greater than air, is propelled upward, it eventually returns to Earth because the forces of gravity influence it. The laws of finance similarly state that markets that undergo periods of rapid price appreciation or depreciation will, in time, revert to a price point that puts them in line with where their long-term average rates of appreciation indicate they need to be. This is often mentioned as reversion to the mean. Prices within the housing market follow this tendency for mean reversion too. After periods of rapid price appreciation, or in some cases, depreciation, they revert to where their long-term average rates of appreciation indicate they need to be. Home price mean reversion are often either rapid or gradual. Home prices may move quickly to some extent that puts them back in line with the long-term average, or they'll stay constant until the long-term average catches up with them. Price appreciation estimates. Too many home buyers use only recent price performance as benchmarks for what they expect over subsequent several years. Supported their unrealistic estimates, they take excessive risks. This excessive risk-taking is usually associated with the choice of a mortgage, and thus the dimensions or cost of the house the customer purchases. There are several mortgage products that are heavily marketed to consumers and designed to be relatively short-term loans. Borrowers choose these mortgages supported the expectation they go to be able to refinance out of that mortgage within a specific number of years, which they're getting to be ready to do so thanks to the equity they go to possess in their homes at that point. Recent home price performance isn't, however, generally an honest prediction of future home price performance. Homebuyers should look to long-term rates of home price appreciation and consider the financial principle of mean reversion when making important financing decisions. Speculators should do an equivalent. While taking risks isn't inherently bad, and in fact, taking risks is typically necessary and advisable, the key to making an honest risk-based decision is to understand and measure the risks by making financially sound estimates. This is often especially applicable to most vital, the biggest, the most important financial decision most of the people make: the purchase and financing of a home. Lastly, a simple and important principle of finance is mean reversion. While housing markets aren't as subject to bubbles as some markets, housing bubbles do exist. Long-term averages provide an honest indication of where housing prices will eventually end up during times of rapid appreciation, followed by stagnant or falling prices. An equivalent is true for periods of below-average price appreciation. Was this video informative enough? Let me know in the comment section. With this, we come to the end of this video. I hope you all enjoyed watching this video. If you do, don't forget to like, share, and subscribe to our channel. See you soon in another fun video.